Hey everyone, welcome to the video. My name's Mike Stokes, and on this channel we talk about all things entrepreneurship, tech and venture investment. In today's video we're talking about a concept that completely changed the way that I look at venture capital investment. And that concept is the power law. Now, I go as far to say that if you want to truly understand the world of venture, and if you want to be a successful VC investor, then you have to understand this concept. The power law is one of the key reasons why VCs are so obsessed with finding the next tech unicorn, as opposed to investing in just average or even good companies. In this video, I'm going to cover what the power law is, as well as how it impacts the way VCs make investment decisions. So let's go. So most things in our world follow a normal distribution. As you all know, this means that most things in the world that we live in are either average, or if they're not average, they're not far from it. You'll recognize the bell curve. Let's take IQ as a really quick example. And it's not just IQ that follows a normal distribution. Things like shoe size, height, and even dancing ability. So I'm afraid that without even seeing your TikTok videos, I can tell you that you're probably pretty close to average. However, things change when you look at venture capital returns, because most people accept that these returns don't follow a normal distribution. Instead, they follow a power law distribution, which looks like this. Long story short, this means that small outcomes are most likely and large outcomes are less likely, but they do happen. Crucially, power law distributions have fat tails, which means a small number of significant outlier values. Now, this applies to venture capital because a significant amount of success and subsequent returns come from a very small number of venture capital investments. Data from Horsley Bridge indicates that amongst top performing VCs, 4.5% of their invested capital generates 60% of returns for those funds. This is the power law in action. Now, the substantial returns that I mentioned come from what's known as outliers. Companies that do so well that they generate at least a 10x return for the VC, and sometimes a lot more. And these outliers are what VCs spend their time looking for. A good example of an outlier is Peter Thiel's angel investment in Facebook. So he invested $500,000 in Facebook and ended up generating $1.1 billion from that investment. Not bad. Now, these outlier companies sit on the far right-hand side of the power law distribution. Companies like Airbnb, Uber, Facebook, Instagram, Dropbox. Now, the whole game for VCs is that they try and find and invest in these outlier companies so that they can make substantial returns. But in reality, most of the companies they invest in will be on the left-hand side of this distribution and won't return any or much money at all. Now, the power law results in two significant impacts for venture capital investors. Firstly, VCs need to invest in a portfolio of companies, because the more investments they make, the higher the chance of finding and investing in an outlier company and generating substantial returns. Now, as you'd expect, there's a lot of great data available on how portfolio size impacts potential returns for VC investors. But I think this table from Jerry Newman summarizes it really well. Now, as you can see, if a VC wants to make a 3x return for their investors, they have a 15% chance of doing that if they invest in 5 companies. But they have a 23% chance of doing that if they invest in 30 companies. Now, of course, it's really important to remember that VCs can't just build an endless portfolio of companies to maximize the chance of generating return for their investors. In reality, they need to balance the size of their portfolio with the capacity they have to support their portfolio companies. The second impact the power law has on venture capital investors is that it means they should only be investing in companies that they truly believe can generate substantial outlier returns at some point in the future. If they don't do this, they risk investing in a portfolio of average companies, and as we know, because of the power law, that's unlikely to generate the returns that that VC will be looking for. Now, to do this successfully, a lot of people argue that VCs have to be willing to either hit big or miss big with their investments. In VC, people talk a lot about the Babe Ruth effect. Now, Babe Ruth was a baseball player who was well known for either hitting massive home runs or completely missing. You can tell I don't know much about baseball, but you get the gist. And the argument here is that the same principle applies to venture capital investors. If they want to generate significant returns, they have to be willing to swing big and risk missing completely. Now, I think this chart from Chris Dixon summarizes this pretty well. As you can see, low performing funds end up making a lot of investments that lose money. So funds that generate a 1x return for their investors make money losing investments around 75% of the time. And as you'd expect, good VC funds, funds that generate a 2 to 3x return for their investors, make fewer money-losing investments than low-performing funds. But where this gets really interesting is that the highest performing funds actually end up making more money-losing investments than the good funds do. So although a higher percentage of their investments do lose money, these funds hit bigger when they make a successful investment. They find the outlier companies and generate the substantial returns that come with them. This is a great example of the power law in action. So in this video, we spoke about the power law and the impacts it has on venture capital investors. As I mentioned, this concept really did change how I look at venture investment, and I hope it's been useful for you as well. If you enjoyed the video, please hit the like button, and for more content like this, please subscribe to the channel, and I will see you in the next video.